Here's 4 things that 99% of real estate agents won't tell you about your home equity. So you've gained a ton of equity over the past few years. The stats show that houses continue to increase in value. So if you bought a $700,000 home in 2021, that house is now worth $833,000 in 2024. So hopefully you know this, but if you don't, comment the word equity below and I'll send you a free report of your home's valuation, no questions asked. Now the question is, how do you use your equity? Now here's 4 ways how to effectively use your home equity. Now a lender that I trust says you should take out a HELOC, a home equity line of credit, just to have on file. Now why? There's 2 reasons why you should do this. The first is that it drastically increases your credit score, right? So you have a home equity line of credit, you have a line of credit of about $100,000, for example. So you take that money out and now you have a credit card with $100,000 of a balance, but you're not using it. So it is increasing the amount of credit that you have available, but you are not using it. So your debt to income ratios on credit are a lot better. And the second one is kind of obvious, but you have that on file for you in case you ever need it. So in case of emergencies. Now, the way that a home equity line of credit works, if you were to take out money, you're paying the interest only on that until you pay it down. Now, here's a few ways on the 4 ways that you can use your home equity line of credit to increase your financial situation. The first thing you can do is finance the home improvements in your home. So if you've been thinking about doing a kitchen, a bathroom, some paint, some carpet, any projects around the house, and you know that you have $130,000 in home equity down that you can use, you can now borrow that money, finance the project, and increase the value of your home. Now, the second thing you can do is you can settle outstanding balances with your line of credit. Now, how do you do that? So say, for example, you have a credit card that has a $20,000 balance. Now, credit cards are historically known for having 15 to 20% in the interest rate, right? So you can take your home equity line of credit, which is the going rate plus whatever premium they put on, which is only 1 or 2%. So you could have a credit card balance at 20% with $20,000. You borrow the home equity line of credit, $20,000, and you pay that off. You now have reduced your interest that you're paying from 15 to 20% down to say 8 or 10%. Now this is going to save you hundreds of dollars overall in interest payments, but now you're consolidating your debt into one place, which is your home equity line of credit. Now the third option is one of my favorites. It's get a business going. If you have a business idea and you've been trying to figure out how to fund it or how to get it going, borrowing from your home equity line of credit could be a good use of those funds. Now, if you wanted to buy an investment property or get a business going in the terms of investing in properties, you could borrow, say, $30,000. You could put 20% down on a property, then you can have your closing costs. You can acquire a property that starts cash flowing for you and get a business going. And the fourth option to use your home equity line of credit is simply what I stated at the beginning, which is just to keep it on file in case you have an emergency. So the idea is not that you have this money and you have to run up a balance for it. The idea is that it is increasing your credit score, which allows opportunities to happen in the future in the form of maybe qualifying for a better mortgage, maybe qualifying for a better car note, interest rate loan, or whatever it may be. But it gives you flexibility and peace of mind to know that, hey, if an emergency happened, a family emergency or something, and you had a huge medical expense, you can take care of it with the home equity line of credit because it's very easy to draw from. So having equity in your home, real estate as a whole is seen as a forced savings account. It is not an actively increasing investment on your property. So in times of uncertainty in the market, real estate tends to go up because the values of the property are gradually going up, right? Like a savings account. It's safe money. You know that if you put your money in your home, it will appreciate over time. Now, this forced savings account is good for a lot of people because the big majority of everyone is terrible with managing their finances. So these were 4 ways that you can use your home to leverage your financial situation and improve it.